My talk is about the influx. Probably, I was just talking to John Black here. He's been involved in this as well, about the influx of maybe a third wave that we've seen in our careers of Australian miners coming to North America. And so it's all about Australian miners getting rooted in the Western Hemisphere. There must not be any Australians here if nobody's chuckling. Okay, that's all right. That's all right. Okay, so what we're going to talk about is the changing commitment to the Americas. And again, this comes in waves. The growth constraints right now that they're seeing in Australasia, that are probably driving this, their capacity to do what they're doing based on their valuations and balance sheets, the impact of the Australian gold price. So we know, the Canadian gold price, the Canadian dollar is weaker, and so we do have some benefits of the in Canada, but I'll show you that the Australian dollar gold price is much more beneficial right now. And then what is the capacity of the ASX listed companies who, are smaller in terms of the market? Do they have this capacity to keep doing what they're doing? Okay. So I used to live in Australia, so I lived there for about 4 years. I did a master's there in Queensland, and I worked mostly in Queensland for a company called Mount Isa Mines, MIM. And around the time I moved to Argentina from Australia, we would see Australians starting to test the waters in South America and in North America. But what would usually happen is they would invest big, blow their budgets, and then when they found something back in Western Australia or somewhere else in Asia, they would pull up roots, leave, and then go back to Australia, to Australasia. Because what they felt like at that point, like people like Newcrest, that, here's where we work, here, and nobody else is competing with us. There's not a lot of North Americans here, and, we've got a comparative advantage in this jurisdiction, in that area, in that region. MIM's purchase of Bajo de la Umbrera around the mid-90s would have been an anomaly, would have been somebody actually going out and taking a big stake in a development project. They bought half for $130 million. I think the upfront capital was about $600 million. It ended up being, I believe, about 1.2. And so, that's life. But the seeds of this new trend that we're seeing was probably planted in 2015 by Oceana Gold. And so when we saw Oceana Gold come in 2015, and Oceana Gold is an ASX-listed company, now it's dual-listed, acquired Romarco, which had the Hale open-pit gold project in South Carolina, which is also underground. It proved to the other ASX-listed companies that a mid-tier producer, or a junior producer, could actually successfully operate assets on both sides of the globe. And I know my time at Newmont, working in planning and working in corporate development, it was tough to work the entire globe because somebody would always get screwed. And usually it would be the Australians, just because we were in Denver. So this movement has been taking root over the past couple of years. And I referenced it last year when I talked about the Precious Metals Summit in Beaver Creek. But also, we've seen it in the joint ventures and the equity placements. And Mirasol's seen it with, we've seen it with through Mirasol with Newcrest investments in two gold projects in northern Chile. We've seen their investments in Mexico. So we've been seeing that for more than 18 months. So there's been about $4.4 billion worth of purchases, including the Hale project back in 2015. And so what you're seeing is not only purchases of companies, but purchases of assets. And what's interesting about this for me is that the premiums, like this is not a great market for M&A, and it's basically a buyer's market, but they're still offering, some of these ones are 120% premiums on Avanco Resources, on the Brazilian assets, 50% premium on the zinc project, the Taylor project by South 32. And the other interesting thing is it's mostly cash. It's not shares. Usually cash in a cycle indicates more an indication that the market's turning. Here, it might be an indication that they just want the transaction to be done quickly and remove that execution risk. And potentially that the sellers don't want ASX-listed paper. Okay, so why are they coming? So this is Newcrest's reserves and resources. So this takes it all the way from 91, shows what they found, what's been growing, and then they had a huge lift post the Lihira acquisition, a big open pit gold mine in Papua New Guinea that we actually at Newmont looked at the same time. But that growth takes you up to a critical capacity where it gets harder and harder to replace those reserves. And so their reserves have been declining basically since 2013. And so this figure is actually Newcrest's figure, and I've bastardized it, basically. So what you see is from that Australasia region that the incentive to go to Africa for some of these ones is not great, and the incentive to go north and keep going into Asia and even Mongolia is not there. So jurisdictionally, they're crossing the Pacific. They're going to North America. And so the red dots basically mirror that histogram I just showed you in the last graph. So that you can see the Pogo asset, the Alaska asset that was purchased by Northern Star. You see Red Chris, 80% of Red Chris, $800 million purchase by Newcrest. You see the recent Atlantic Gold purchase of Nova Scotia, which is, I think, almost the largest distance, because the company that purchased this, Santa Barbara, is in West Australia, and I think that's about, I don't know, 6,000 kilometers, I can't remember. But then you see South Carolina, Hale, down to the southeast of the States. You see the equity private placements of Oceana Gold in companies like Gold Standard. You see the private placements and the investments by Newcrest in Ecuador. And also you see the Avanco purchase by Oz Minerals in Brazil. And also those placements and joint ventures like with companies like Mirasol in Chile. And also people looking for things in Argentina. But then you see on the upper left, you see another company, Evolution Mining, that's basically talking about their approach to upgrading the pipeline. And one circle that I noticed in their presentation was actually about evaluating North America. And sorry, just to get back to that statement that I put down there at the bottom, it's an interesting time in that they're not going to get a lot of competition from the North American producers at this moment because they're all consolidating, and if anything, they're sellers, not buyers. And so now we have these companies adjusting their geopolitical risk. Okay, so the green bars basically represent the states that they're operating in. Okay, like the Fraser Institute goes into states and goes into provinces of Argentina, and so does a lot more detail. But you can see Western Australia is all the way to the left. It's one of the best jurisdictions next to Nevada. So what these guys are doing is basically taking some of those red areas that they're in right now and not wanting to grow there in preference to some of these other areas that are in black. I'm not saying that all of these places are low geopolitical risk, like Ecuador or Argentina, but they're willing to take that chance because they want to grow. The ability to overthink something. Okay, this is Evolution Mining on acquisitions. And so it's an interesting, because we used to do this at Newmont. We had this strategic fit score that me and the guy in Treasury put together. But you could see what they're trying to do. So most of those acquisitions were commodity-specific, gold, copper, but the biggest transaction was actually zinc. And so a lot of these assets that you're seeing being purchased right now are not development assets, but actually in production. So that operational complexity is basically alleviated. But then also these guys are bringing something to the party. Whether it's Newcrest with Red Chris, understanding block mining, which is something Imperial wanted to avoid and push off, these guys want to accelerate. And the capital required. A lot of these assets need capital, And the companies operating them weren't willing to put that capital in. And they're willing to cede 100%. Granted, the only one that I showed you that was 80% was Red Chris, because Imperial had no other positive free cash flowing asset, and they needed that. All-in sustaining costs, like them low. Annual production, like it high. Mine life, the longer the better. This is all obvious. But the other thing is exploration upside. So with Pogo and Northern Star, one of the big things is, at Sumitomo, they didn't do as much exploration. It was a great mine, high grade, underground, but these guys are coming in and looking at expanding it. The other thing is the transaction complexity, and this gets back to the premium and the cash. You can eliminate the complexity by giving them cash. You'll eliminate the complexity of doing the deal by giving them a premium. The social license to operate is also alleviated a bit by buying operations versus development assets. Okay, how can they do this? So some of this is interesting. Because you're looking at this graphic from Regis and Canaccord Genuity, like what you notice right away is that the entire peer group, Australians, are all on the left-hand side. Some of this is just basic math on the Australian dollar. But also, operationally, they're doing quite well. So in Australia, especially Western Australia, labor becomes a huge issue. And when the boom was happening, when LNG plants were getting built, they were big on the iron ore, the labor costs went through the roof. You're in a mining boom in Perth if you get into a taxi and nobody knows where you want to go, because all the taxi drivers are at the mines working. Here, we have an instance where you can actually grab a cab and know where you're going, because now they're not building these LNG plants. Now the iron ore market's not going nuts. These guys can actually control their labor costs. And the other thing they do is that they use low reserve prices. And so that's the gold price right now in Australia, $1,850. But some of these companies are down to $1,400, giving them a huge gap. They can mine higher grade, better margin. So they're thinking about cash flow. They've been thinking about it for the last 2 years. And it's only recently, back in 2 years ago, that the big companies are starting to lower their gold price. And that's why you see a lot of their reserves coming off, and I've talked about this before. And so this is a perfect example. Look at Regis. Regis is showing you growth in reserves with the McPhillamys asset, and that asset was actually a Newmont asset that was too small for them, and they bought. And now they're developing it in New South Wales. But what you can see is that flat line on the right-hand, the right-hand side, where you can see how they're trying to control their costs, flatlining those. And into that, they're stabilizing production, but importantly, that line that you see is the Australian gold price, that's actually spiking. So they're controlling their costs, bringing in production, and making more money. So they're not counting on the gold price saving them, but they're reaping the benefits. So the annual free cash flow, Australian tax year ends in June, and so they're into their half year of the next fiscal year. So I did 4.5 years of financials. And some of these companies do end of December, so some of these are 4.25, but I annualize this. And so this is the kind of cash flow, free cash flow, that they've been generating over the last 4.5 years on average, so about 120 million. There's not too many companies in North America that have been generating this free cash flow. There's only 4 companies that were generating negative free cash flow. If I showed you this graphic, which I have done before, there'd be a lot more North American companies not generating any free cash flow. And so this was an example, Newcrest. Over the last 5 years, they've generated $3.5 billion Australian of free cash flow. So you wonder where'd they get that $800 million to buy Red Chris. You wonder how they do all these private placements. Do it in Lundin, and in Sol Gold. They're all over the place. And then the average working capital, so you generated all this free cash flow. So on your balance sheet, they're sitting with, on average, $390 million of working capital. So they've got the treasury that a lot of North Americans don't have. If anything, the North Americans are on the left-hand side trying to divest to bring their treasury back up and pay off their debt. Every time you see those red circles, those are companies that have been active in North America. So you see the ones with the biggest working capital have been very active. The other part is the valuation. So if they actually did use their shares, which most of them don't, they have strong valuations. On average, since December 31st, 2015, they've generated 170% average return. And this is actually just doing work, bringing mines into production, generating free cash flow, and doing what they say they're going to do. That's it. And then having the gold price come up while they're doing that. So if we take that, so this was in Australian dollars, the return in Australian. So you'd say, well, what does it look like in US or in North American currency? So I take 30% off that return if I convert it to US. Okay, but look how much they beat the GDX and the GDXJ. There's only 2 companies that didn't beat it. So an average return US about 140% from 170. So now we can look at the gold price impact. So the yellow line is actually the US dollar gold price. The green line is the Australian gold price, and the blue line is the Canadian dollar gold price. And so what you would notice is around here, there's a bifurcation here where the Australian gold price starts shooting up and the Canadian gold price goes down, and then it flattens around here. So that's about PDAC 2018, March. So if we look at that more specifically, you can see this is the Australian gold price, doing much better than the Canadian dollar gold price and obviously the US dollar gold price. So over that period, it was actually up 10%. So obviously, that's got a lot to do with the currency. And so that same bifurcation you see around March 2018 is around here, right around there, sorry, where this starts taking a steep fall and this flattens. So that means the Canadian dollar gold price isn't doing much, whereas the Australian dollar gold price is going up because it's weakening faster. So you see that same curve from March, where the Canadian currency is basically stabilizing, but this one's plunging. And then we've had another recent plunge. What's driving that? The vast majority of Australian exports go to China. Their biggest trade surplus is with China. Their biggest deficit, one of their biggest deficits, actually with the US. So they need China. But unfortunately, China's growth has been slowing. Part of that is just because it's so big now that you're never going to get the same 12 to 15% returns. But the other thing is all the issues since Q1 18 about the trade tariffs, the dispute with the US, who happens to be China's biggest trade partner, in the end is impacting Australia. So China sneezes, Australia catches a cold. So how much capacity does this smaller market actually have? Okay, so this, I'll explain this graphic. Okay, this is what I put as net working capital, because I was going to do net debt, but net debt would be a positive when it's really a negative, so I just switched that number around. So what you want to be is on the upper right. And then I normalize that, because some of these companies are big, like South32 and Newcrest, by their enterprise value. Okay? So companies over here are doing well. They've got lots of cash, they don't have much debt, and a proportion of that's very positive with respect to what they're holding in terms of their enterprise value. These companies, not so well. So what we would expect is companies on this side of the curve still have the powder to do something. Some of these guys have already done things. So if we start with Oz Minerals over here, who's got a lot of money, but if you go to their presentation, they've got so many projects in their pipeline, I'm not sure if they're willing to acquire more with respect to their capital spend. SBM, which is St. Barbara, which is that. But this is prior to the Atlantic purchase. After they acquire this asset, they're going to be digesting this, so it might be a while before they ever do anything again. And it's a small company. Sandfire, which is more base metals, has money, but they're problematic. Oh, not problematic. This could be a candidate. They're going to be spending money in Black Butte, Montana on a VMS polymetallic deposit to the tune of about $220 million. But they already have a U.S. company. So they've already got feet on the ground looking at assets. So I should think that they might be in the mix. The other one, is this one called Silver Lake. They've already acquired an asset in West Australia, so I'm not sure if they'll be in the mix. But Regis, I think, will be. They have purchased that asset from Newmont, McPhillamys, but they've got the working capital, and they also, I think, have the means to come over here, and potentially the will. The other one is South 32. That's just a big company. It's got a great working capital position, and they're constantly looking for new assets. And part of Trilogy's valuation is based on the fact that South 32 is their partner. And if that road gets built, that project's looking a lot better in terms of South 32, maybe potentially taking that one out. The other one is, the issue with a lot of these Western Australians is they can be very parochial. They'll just stay there. They won't go anywhere else. And there's a few of these companies that are just too small to come over here. And that would include companies like West Gold, Saracen, basically mine where we mill, and in their presentation they're talking about being purely Australian. The one that I would probably say the top of the list might be Evolution Mining in terms of coming over here, because that was the one I showed you in the box that was talking about actually coming here and evaluating projects here. The issue for them is that there'll be so many projects to look at, because we know we got the Newmont Gold Corp divestiture, and we know their CEOs want to divest $1 to $1.5 billion to offset the debt that they're taking from Gold Corp. We know Barrick is divesting assets. We know Pan American is divesting assets. So there's a whole bunch of companies divesting assets. And so if these companies can come in and say, hey, I could do this better, I could put the cost down, I can invest in a shaft, or I can invest in underground development, or I could do something like that and generate more cash flow, those are the sort of assets they'll look for. They won't hopefully look for social license to operate issues, permitting issues, or a jurisdiction nobody else wants to go to, because right now it is a buyer's market. So to conclude, okay, so the growth in Australasia is challenging right now, especially if you want to grow in stable mining jurisdictions, because outside of Australia and New Zealand, they just basically don't exist. So we've had $44 billion spent in this last wave, or recent wave, over the several years, but these don't include the joint ventures and the smaller private placements that have been happening. And then we have the costs in the ASX, been very low, high margins. That's been supported by stable labor costs, weak Australian dollar, excellent execution on the part of the companies, and the stable jurisdiction with respect to Australia. The low cost that they've generated, the low all-in cost, the high Australian dollar gold price, which is now at about $18.50, supports the high margins, generates the positive free cash flow, underpins the strong balance sheet that they can bring here. The China-US trade dispute is supporting that weak Australian dollar and the high gold price locally. The potential ASX-listed suitors that might have the capacity right now to keep this wave going may be Evolution Mining, Regis, Sandfire, and South 32. All right? Okay, that's it for me. Thank you very much.